Hey guys, my name is Dini and welcome back to my channel. So today I'm going to be showing you guys something that you've all been waiting for. My exact Forex trading strategy. All of you have been asking me over the years about my strategy and if I can share it on YouTube, and today's the day that I share it. So without any further ado, hit the like button, subscribe, and let's head over to the screen. And did you know I have a full trading course called the Forex Mastery Course? I teach it all on my Patreon, so click the link below and you'll get more information on the strategy and exactly how to trade in a step-by-step manner. So check it out, click the link below so you can learn. Introduction to the 20% strategy. What is the 20% strategy? The 20% strategy is a strategy I created that changed my life. I found this strategy after deciding to spend hours on the chart looking for patterns that appeared often. When it first came out, it was called the 50% strategy. The 20% strategy, in simple terms, is setting your trade target to 20% of a valid candlestick. So that's the definition. The 20% strategy rules. Rule number 1, the time frame. The 20% strategy only works on the 1 minute time frame, so make sure to use that time frame. We spot setups and base most of our rules around the 1 minute time frame. Rule number 2, valid candlestick. The 20% strategy first begins with finding a large candlestick. What do I mean by a large candlestick? A candlestick body must be a minimum of 5 pips in order to be considered a large candlestick. So what I mean is the body must be 5 pips. Otherwise, if it's 4.9, 4.8, then no, it's not a valid candlestick. Now, you're going to hear me say large candlestick many times when explaining the 20% strategy. Now, just for clarification, the large candlestick, what I mean by the large candlestick is the candlestick that is a minimum of 5 pips. That's what we consider the large valid candlestick. So if you hear me, mentioning a large candlestick, it's the first candlestick in our system that has a minimum of 5 pips. The body is a minimum of 5 pips. So it's the first candle that we consider the large candlestick. So yeah, that's what I mean by a large candlestick. Hold up, did you know this video is sponsored by bit.com? Bit.com is a crypto exchange platform and it allows you to buy and sell crypto. I love bit.com and I personally use it, so I recommend joining bit.com. The link will be down below. They offer good leverage and they have good security and liquidity, so check them out. The links will be down below and you'll see them more in my videos because I personally use it and I recommend it, so check it out. Links will be down below. Rule number 3, the opening of the second candle. In order to have a valid setup, the second candle after the large candlestick must open above or below the large candlestick. So if the large candlestick is bullish, the second candlestick must open above the large candlestick. If the large candlestick is bearish, the second candlestick must open below the large candlestick. So we have an example. As you can see on the right side, we have a bullish setup. We have a large candlestick which is labeled as 5 pips, and we have the second candlestick right above. And as you can see, the second candlestick has opened above, right? It's not touching the large candlestick, it's opened above. Now we have a bearish example. So we have the 5 pip large candlestick and the second candlestick that follows has opened below. So make sure your second candlestick opens above if it's bullish or below if it's bearish. So if the large candlestick is a bullish candlestick, then the second candlestick must open above. If the large candlestick is a bearish candlestick, the second candlestick must open below. Rule number 4, second candlestick should be smaller. The second candlestick after the large candlestick must be smaller than the large candlestick in size. The large candlestick should always be bigger than the second candlestick, otherwise the setup will be invalid. For example, if the large candlestick is 5 pips and the second candlestick is 10 pips, the setup will be invalid. So always check the size of the second candlestick. Now, as you can see on the example on the right, the first large candlestick, which is 5 pips, is small, and the second candlestick that opened below, right? So it opened below, and that's valid, but the problem is it's bigger than the first candlestick. And if it's bigger, then it's invalid regardless of whether it opened above or below, right? So in this case, the second candlestick opened below, but it was bigger than the first candlestick. Rule number 5, plot your 20% take profit zone. The reason why I named it the 20% strategy is because our take profit level is always 20% of a large valid candlestick. So you need to identify roughly where your 20% will be. If you have a bullish large candlestick, then the 20% take profit zone will be near the top of the candlestick. If you have a bearish large candlestick, then the 20% take profit zone will be near the bottom of the candlestick. This allows you to know exactly where you will exit a trade before you have even taken it. So as you can see on the examples on the right side, let's start with the bullish candle. The blue bullish candle, which is 5 pips, right? The take profit for that is at the top of the candle. Why? Because it's a bullish candlestick, right? If you have a bullish large candlestick, the 20% take profit line should always be placed at the top side of the candlestick. The reason why is because when you have a bullish candlestick, then that means your trade is a sell trade, right? And if you're selling, then the top half of the bullish candlestick will be your take profit after, your trade has met, the entry rules. Now with the bearish candlestick, it's the opposite. So the 20% take profit line should be placed near the bottom of the candlestick. Why? Because it's a buy trade, right? If you have a bearish candlestick, you're expecting price to go down further and then you'll buy, and that buy trade will have the bottom of that bearish candlestick as the take profit zone. Don't be afraid, because I will explain this on the charts, to make it easier to understand. Rule number 6, the minimum profit target should be 100 pips. The minimum profit target for the 20% strategy is 100 pips. That means the distance from the 20% take profit zone to your entry must be 100 pips before you can decide it's a valid setup. If a trade setup only gives you 60 pips, then that is not valid. You must wait for the price to meet your minimum 100 pips rule. This protects you from entering setups early and also gives you much less of a drawdown. So as you can see on the example on the right, we have a large candlestick which is labeled as 5 pips. So we are expecting price to go down, and it goes down. When it goes down, it hits our 100 pip, minimum mark, which you can set on the charts, right? And then we can place a trade because the rules have been met for a minimum of 100 pips. Now there's more to it than just 100 pips. So you should have 100 pips as your minimum take profit. That means for every trade you take using the 20% strategy, you will make a minimum, or you will aim for a minimum of 100 pips. Rule number 7, make sure the RSI is oversold or overbought. The RSI indicator stands for Relative Strength Index, and its job is to tell you the strength or weakness of a currency pair. You cannot enter a trade using the 20% strategy until the RSI is overbought or oversold. What do I mean by overbought and oversold? Well, overbought means the currency has gained so much strength and is being bought by a lot of people, which is why the currency pair is going up. Oversold means the currency pair is becoming weak and it's being sold by people, which is why the currency pair is going down. Now here's the important part. The RSI indicator must be 70 or above or 30 or below for your setup to be valid. If you have found a sell setup using the 20% strategy, then the RSI must be 70 or above. If you have found a buy setup using the 20% strategy, then the RSI must be 30 or below. Now, as you can see on the right side, we have the RSI. So there are two numbers you need to focus on, 30 and 70. If price goes below 30, it's oversold. People are selling. If price goes above 70, it's overbought. People are buying. In order to have a valid setup, the RSI needs to go 30 or below or 70 or above. Otherwise, your trade will be invalid. Regardless of if everything is aligned, you have all the rules, but the RSI is not meeting the rules, then your setup is invalid. So please make sure the RSI is 70 or above or 30 or below. So yeah, I will be explaining how to apply all of this knowledge on the charts. Don't worry, you will understand more. And yeah, what are valid/invalid candlesticks? The first two candlesticks are very important when using the 20% strategy. The large candlestick has its own rules, and so does the second candlestick that comes after. I have designed these rules after years of backtesting. These rules allow you to spot what setups are valid or invalid. The two golden rules. So say you spot a large valid candlestick and you're now looking at the second candlestick. Well, the first golden rule is that the second candlestick should completely be above or below the large candlestick. The second golden rule is that the second candlestick should always be smaller than the large candlestick. So if the first large candlestick is 5 pips, the second candlestick must be smaller than 5 pips. If the first candlestick is 20 pips, then the second candlestick must be smaller than 20 pips. When you understand these two rules, you will be able to differentiate between valid or invalid candlestick setups. Now let's go ahead and explain these invalid candlesticks. All these candlesticks you see here are invalid. So let's start with the first one. We have a setup here and we have the first large candlestick and the second candlestick. Now what's the problem with this? Well, it's simple. The first rule was the second candlestick must completely open below or above the first large candlestick. Now if you have a look, the second candlestick has not opened completely below the first large candlestick. It's in fact opened in between the first large candlestick, right? It didn't open below the wick or this tail here. That's why it's invalid. It did not open below. When I talk about completely below or above, I mean completely including the body and the wick, right? If this candlestick opened below, it would have been valid, but it opened in between the body and the wick or the tail. That's why it's invalid. The second candlestick cannot touch the first candlestick. And when I say candlestick, I mean the body and the wick together. This is the body, this is the wick. Together we call them candlestick. Now, number 2, we have the first candle, second candle. What's the problem? Well, the second candlestick is touching the first candlestick, right? The wick of the second candlestick is touching the bottom wick of the first candlestick, which is why it's invalid. Golden rule number 1, second candlestick must completely open above or below the first large candlestick. There are no exceptions to that rule. So in this example, the wick of the second candlestick is touching or is side by side with the wick of the first large candlestick. So that's why it's invalid. If this candlestick opened below and it was right below the wick of the first large candlestick, then yes, it would be valid, but it's not the case. Now we have number 3. We have the large candlestick and the second candlesticks. There are 2 problems with this. It's not opened below, and that's number 1. That's the number 1 problem. Second candlestick has not opened below the first large candlestick. Problem number 2, if you were to have the 20% take profit line just here, the wick of the second candlestick would have already hit the 20% take profit line. So that's an invalid trade, right? So be careful. Make sure the second candlestick is below and the wick is not touching the take profit line. Now, number 4, it's very simple. We have the first candlestick and the second candlestick. What is the problem? The second candlestick is breaking golden rule number 2, which is the second candlestick must be smaller in size, right? If this was 5 pips, second candlestick would be 50 pips or something, right? So make sure the second candlestick is smaller than the first candlestick. But now we have the valid candlesticks. Number 1, we have a pretty basic one. First large candlestick and the second candlestick, right? The second candlestick has opened below and is perfect. This is the most perfect setup you can get. So that's why it's valid. Number 2, we have the first large candlestick here and second candlestick. The reason why it's valid, the second candlestick opens below the first large candlestick, right? The wick is below the body of the first large candlestick. If this wick was bigger and it was touching the body of the first large candlestick, then it would be an invalid setup. But the wick is lower than the body of the first large candlestick, and the second candlestick as a whole, body and wick, is below the first candlestick. That's why it's valid. Number 3, we have the first candlestick and the second candlestick. Why is it valid? We have a wick here, but the body is not touching the wick. It's lower than the wick, right? The first golden rule is that the second candlestick must completely be above or below the first large candlestick. Now, in this case, it's completely below, right? It's not touching or interfering with anything to do with the first large candlestick, body or wick. The second candlestick is completely below, and that's why it's valid. Number 4, we have the first candlestick, second candlestick. This one's a bit more complex, but the reason why it's valid is because, right, we have a wick here, another wick here, and they're not touching each other, right? It's still following the rule, right? The second candlestick is smaller in size and it's completely below the first large candlestick. It doesn't matter what it has, wick or no wick. It needs to completely be below the first large candlestick, and the second candlestick cannot touch anything to do with the first large candlestick. So if the body was the same, but the wick of the second candlestick was, slightly higher, and it was, level to level with the first candlestick wick, then it would be invalid. The aim here is to make sure the first candlestick and the second candlestick do not interfere. We need it to be its separate candlesticks. We don't want the second candlestick touching or being at the same level as the first candlestick. So yeah, I hope you guys learned, the difference between valid setups and invalid setups. Just follow the golden rule and you'll be good. And remember, this takes practice, right? This takes practice and it takes time. Try it on a demo account and, take it from there. Don't try to learn this in one day, because you won't. This was years of experience that I'm explaining in a few minutes. So make sure, you practice, because practice makes perfect. How to have better entries with the 20% strategy. Why does the entry of a trade matter? It's impossible to have a trade with zero drawdown. There will always be drawdowns. However, if you can work on getting better entries, then you will make more per trade. Let's say you enter a buy trade hoping to make 100 pips. And when you enter the trade, price goes against you and you're now minus 30 pips. And now let's say another trader saw that same buy setup but was waiting for a better entry, and now after price has gone down minus 30 pips, he enters the buy trade. The second trader could now profit 30 pips more than you, and also now has his stop loss set 30 pips below the first trader. The second trader has a lower probability of getting their stop loss hit compared to the first trader. Having good entries matter. How can you get better entries with a 20% strategy? There is one thing you can use alongside the 20% strategy to help you get better entries: support and resistance. Let me explain. How support and resistance gives you better entries. Support and resistance zones are levels where price struggles to break above or below. When you combine the 20% strategy with support and resistance, you target zones where price has a higher chance of reversing from, which increases the probability of having a winning trade. How to use support and resistance with the 20% strategy. When you find a valid 20% setup, then you either enter the trade after the rules are met, meaning, after the 100 pip minimum rule, or you can use support and resistance to find a better entry. Both are fine. Not every trade will give you the opportunity to use support and resistance, because sometimes there are no support and resistance zones near the preferred entry. So yeah, if you don't happen to find a very good support or resistance level near your, setup, then that's okay. Don't worry about it. You can still enter the trade. Step number 1, have a valid setup. Before you think of using support and resistance with the 20% strategy, you need to have a valid 20% setup that follows the rules. Only when you have a setup can you possibly apply support and resistance. So make sure all the rules are followed. Minimum 100 pips. First candlestick is minimum 5 pips. Second candlestick is below or above, right? Second candlestick is also smaller. Make sure you're following the rules. Step number 2, set up your support and resistance zones. You need to have your support and resistance zones ready at all times so that when you have a valid setup, you can decide if there is a support and resistance zone you can use. What time frames can you use for support and resistance? Well, you can use the 1 hour, 4 hour and daily. Although the 20% strategy is first analyzed on the 1 minute time frame, you can use the 1 hour, 4 hour and daily time frame to get better entries using support and resistance. So yeah, don't go below the 1 hour. Between the 1 hour and the daily time frame is where you need to set your support and resistance zones. Step number 3, enter using the support and resistance zone. It's really that simple. When price is in the support and resistance zone, you need to first wait to see how it reacts. Is it slowing down? Is it, increasing in volume? What exactly is happening? And if it seems to be slowing down, it's best to place the trade. And you have increased the probability of having a winning trade by setting your entry on a support and resistance zone. Remember, trading is a probability game. Now let me show you how to apply this on the charts. So we're currently on pound AUD. We find a valid setup. The rules are being followed. So now we're looking to see if our minimum 100 pips entry is good enough, right? Sometimes you'll have your minimum 100 pip entry just on that support or resistance line, so that matches. Or sometimes, you'll have your entry, which is minimum 100 pips, but the support is maybe 30 pips below that. So you'll have a 130 pip trade rather than a 100 pip trade. So let's see what happens. Let's identify our take profit. So that's our take profit. Now, just to make sure it's easier to identify on the 1 hour time frame, I will mark the candlestick, the large candlestick, and I will also mark the entry. So let me zoom out. There we go. So let's go on the 1 hour. So yeah, we're currently on the 1 hour time frame. I have marked the candlestick and the entry. This is the large candlestick where the 1 minute time frame is. Price comes down. Now this is our minimum 100 pip entry. I usually set the minimum 100 pip entry and I zoom out and I go on the 1 hour time frame to see if it's a good level. Now in this case, if I move this out of the way, you can see price goes down, touches that support level, a little bit of a drawdown, 10-13 pips, right? And then it goes back up and hits take profit. So that's what I mean by having a support level as an entry. Now in this example, the support level was the same level as our entry, so that's that's very lucky if you ask me, but that's really good. Let's see if we can go on the 4 hour time frame to see if we have a level of support there as well. And yeah, as you can see, The large candlestick, price comes down, hits this 4-hour support as well. Very good support, which was a resistance level. So it was resistance turned support. So yeah, if you can use a support level, always use a support level, because it's always better to have a higher probability of a winning trade. Lastly, I'll check gold. So we have a setup here. This is our large candlestick. So let's mark this, and this would be our entry. Okay, so all you have to do once you identify your candlestick and your minimum 100 pip entry, go on the 4-hour or 1-hour time frame. So let's go on the 4-hour time frame. And yeah, if you have a look, the bottom blue is our take profit. That's where the large candlestick is. The top blue is our minimum 100 pip entry. When I set my entry, I check to see if it's a good level, and as you can see, it was a support level, it was a previous resistance level. And in this example, would I have entered here? Yes, because of these support levels, right, and the previous resistance level rejection. So yeah, that's a good level. If we go to the 1 hour, we can see it was previous support, now struggling to break above. So yeah, although price came close to the stop loss, again, you ended up winning. So that was a good trade. And also, one tip is that, don't worry about having that perfect support or resistance level, because there will always be another support level or resistance level. For example, there could have been another resistance level here, slightly higher. I could have entered here. So if I said to myself I could enter right here, I would have missed out because price would not have gone to that level. So sometimes, just understand the best area, or just pick a zone or a level that you think is best, and then enter the trade. Important things to know about the 20% strategy. There are a few things you need to know about my strategy that will help you understand more about it. Number 1, I only trade the pound pairs and gold. When I first started trading using the 20% strategy, I used to trade all the pairs, but I found that I had more setups coming from the pound pairs and gold. I have been trading pound pairs and gold for a long time now, and I'm loving it. Setups also appear more often on these pairs. If you're looking to trade other pairs, I would suggest demo trading and testing to see if it's for you, but I would highly recommend pound pairs and gold. Remember, you don't need to trade all the different pairs to make money. Stick to a few pairs and master it. Number 2, do not use TradingView. I have never used the TradingView platform to look for 20% setups, because TradingView shows the wrong candlesticks on the 1-minute time frame. So please do not use TradingView, otherwise the candlesticks will look different compared to MetaTrader 4. I will do more research into this and see if there's a solution, but for now, stay away from it and use MetaTrader 4. So just download MetaTrader 4, the software which your broker should give you, and you'll be good to go. Number 3, use a low spread broker. I personally use IC Markets as my broker and would highly recommend it because it shows you the correct candlesticks on the 1-minute time frame and is important when trading the 20% strategy. If you're not able to join IC Markets, then look for a low spread broker and do some testing. Don't be in such a rush to place trades, as this is your future and you want to start the right way. I will do some more testing as to which brokers are fine, but please use low spread brokers. Number 4, patience is required. Never be desperate to place trades. If you are desperate, you need to cut that behavior. With the 20% strategy, you will need to have patience because it's a high win rate strategy that appears a few times a month. Now, I can't put a number on how many times per week setups form, but if I was to give it a guess, I would say 1 to 3 setups a week between all the pound pairs and gold. Now, that could be more or less, but the point is that you need to have patience. So yeah, just to add a bit more context, when people learn new strategies, they expect to always find setups and always be in trades and always be profiting or whatever. You don't need to trade all the time. So let's do some basic math. Let's say you take 3 trades in a week. Now, each trade you take is 100 pips. Now, 100 pips times 3 trades, that's 300 pips. So let's say you lose one trade, so that leaves you with 200 pips. Now, 200 pips divided by 5 days of the trading week equals 40 pips. That means you are technically making 40 pips a day. So don't focus on trading every day, but taking the best trades. If you happen to not trade the first 3 days of the week, and then during the last 2 days of the week you place 3 trades, you still made money. If there are no trade setups during the week, then that is also fine. Let's say you only find setups for 2 weeks of the month, and in those 2 weeks you take 6 trades. Out of 6 trades, let's say you win 4 and lose 2. Assuming all those trades are 100 pip trades, that leaves you with 400 pips profit. 400 pips divided by the whole month, that means you are making roughly 13 pips a day. That's still something. I say that to say don't focus on the now, focus on finding clear setups and working on your skill, and the money will follow. I do know some people will fail with using this strategy due to not having patience, and I also know some people will have massive success. 2 things that destroy a trader: greed and impatience. I wish you all nothing but success. So I hope you guys enjoyed this video. Make sure to smash the like button, and I'll see you on my next video. Peace.